Okay, folks, this teaching is going to be specifically dealing with higher time frame concepts. Okay, the points in focus of this module. We're going to be talking about key levels, what makes a key level, price rejections. All right, so key levels. We're going to be looking at yearly highs and lows. That means the last 12 months. And this is a rolling calendar, not a specific January to December type phenomenon. So whatever today is, go back 12 months, and we'll see what the yearly high and the low is respective to those points. Okay, monthly highs and lows. And finally, weekly highs and lows. So what we're looking for is the long-term macro yearly highs and low, the quarterly monthly highs and lows, and the individual monthly highs and lows, and the weekly highs and lows. Now, what do I mean by weekly highs and lows? We're going to look back last week's high and low. Very simple. Monthly high and low. We're going to look at the last 3 months high and low, and we're going to look at just the last 30 days or whatever the previous month is, its highest high and its lowest low. And yearly, again, is a rolling calendar from whatever today is. Go back 12 months, whatever the highest high and the lowest low is, we'll use that as a reference point. Okay, price rejections. Double top sweeps, that means when we see price action creating very clean equal highs or relatively equal highs, we're expecting that phenomenon to take place where price will drive above those equal highs, reject, and trade lower. Double bottom sweeps, in other words, just to reverse what I just said, anytime on the price action we see equal lows form, we would anticipate should price trade back down to that level or close to it, it would sweep below it, run the sell stops below the equal lows, and then reject and go higher. And a simple run on old lows, that means running out a previous low and then rejecting that and going higher. And then runs on old highs, which is the obvious reverse of what I just mentioned in old lows. An old high gets traded through, false breakout, and then returns back into the range, trading the opposite direction. So I want to take a kind of a field trip, if you will, through price action. We're going to go through the majors tonight. And I want to talk about some things that I think that a new trader should be focusing on and how to use some of these things to formulate an idea or understanding to build foundation and then start building on that with more of the concepts I'll be teaching in my continuing series. Okay, folks, we're looking at a dollar chart. This is the daily. And when we sit down and begin our analysis, at least from a higher time frame standpoint, this teaching is going to be really aimed at those individuals that cannot do a whole lot of intraday charting or trading or day trading or scalping. So what kind of analysis concepts would an individual that has that limitation what is available in terms of analysis or techniques that we can more or less ferret out an opportunity to practice with our demo account. So what I like to do is, number one, I like to cycle through all the majors, but I begin with the dollar index. And from a dollar daily, okay, we can see that we have been trading lower. And ever since around August, we've been consolidating and gone sideways. Now, the prevailing trend has been down for the entire year on the dollar, and we created a rather significant low here, and we've rallied up. So we've broken this high. So since this happened, we've been consolidating sideways, but also notice that we have traded below this low, and we've been inching higher. So using the things that I mentioned on the beginning of the video, we look for relatively obvious support resistance levels. Okay, long-term yearly highs and lows, monthly highs and lows, quarterly highs and lows, and in previous weeks highs and low. Now I'm not going to draw all those levels on here. I'm not going to draw all those on there because this could turn into a 4-hour video and it's really not essential. You can go through the charts and do that. And I'll do it with one chart in this presentation real quick. But the idea is, first and foremost, you want to see where are we trading right now. Are we in a trending model or are we in a trading range market? Right now, we're in a range-bound market, or could potentially be a reversal. If we look at the trend, it's been lower. We have potential reversal point down here, and we've gone sideways. So what could eventually happen is we could shoot higher and aim for these equal highs, or we could roll right over and make an attempt to go lower and retest this low, or try to trade down to it and fail. Okay, we don't know that. So, but you don't need to know that. See, the question I get a lot is, well, how do I know if it's not going to go below this low? What if it stops, or if it goes through it and continues? Well, you have to figure out where the market is right now, and if you believe it's going to go down there, that offers up a range. So you look for opportunities between where you think it is right now, and if you think it's going to go down to that low, that's your opportunity. Okay, that's your range of potential profit. But as it is here, I like to look at what was the most recent run on liquidity. Most recently, we've had it trade above this high, and we sold off a little bit. And then we came right back, roaring higher, trying to maybe run through these equal highs again. And if we do that, we may be reaching for these equal highs. Notice also this low was traded through with this low. So we've already tried to go lower below this low, and it rejected it handsomely. We tried to go above this high here, tried to sell off, but quickly came back. Now, this could still roll over and go lower, but right now we're at a crossroads where if it goes any higher from here, in other words, if we trade up above these equal highs, that may warrant a run to these equal highs. And if it does that, that may be a precursor to a run even higher. Okay. Or because the time of the year, we're at the end of 2017, we're late in the month of December, this thing could just go sideways between the high and the low defined here and just stay at equilibrium. Now, the things you'll learn with experience is there's certain times of the year when the market is predisposed to do certain things. Certain times of the year it's supposed to trend, certain times of the year it goes into consolidation. Right now, typically we're in a consolidation time. Okay, if you look back at the previous years, okay, we have the market trending prior to it and then went into consolidation. And then around March, we start trending down to around August or September. Then it goes into some consolidation again. So the idea of profiling, I think, is beneficial for you, especially if you're looking at higher time frame charts. But the main thing I want you to take away from this presentation is, even though you're not looking at lower time frames and you're not scalping or day trading, those same price action concepts still apply because price is fractal. That means the things that we would see and expect to see unfold in the lower time frames, just not tied to any real time element, we would still expect those same phenomenon to occur on higher time frame charts like the daily. If we go over to the euro dollar, you can see the opposite has happened. This market has trended higher as the dollar index itself traded lower. We've seen the market trade sideways as we saw on the dollar index. Now, again, let's take a look at some ideas here. We've had a high traded through, it broke down, took out that swing low, traded back up in here, broke it. Now we broke this high, we tried to go higher, and now we're sitting with equal lows. We have these lows taken with this low. So again, same scenario. We could be stuck in this range for the remainder of December. If I were a betting man and forcing myself to take a trade where we're at right now, I would expect it to trade lower. Now, will it gun through these relative equal lows? Well, it looks a little bit cleaner for that to occur in opposite direction with the dollar index because we have equal highs up here, and the market could in fact try to trade above these equal highs and reach for that. On the euro, we have a slightly lower low comparable to this low, but nonetheless we could be overall retracing. Now, why would that be most likely to occur and not higher? Is because we've had the market move one direction all year long. Then we went consolidation and we broke above this high here. Should have ran higher, but now we keep breaking a low. Okay, so any further movement below these equal lows, I would see that as momentum building to make an attempt to get below these lows here. Now, how much further below that, we'd have to weigh that out and measure it at the time. But for now, I would anticipate, because of the time of year, we're in late December, the market's already moved, we're kind of like long in the tooth, if you will, for that move. It would be reasonable or healthy to expect it to have some measure of retracement. Now, if it trades above this high, then we would be aiming for these highs to be taken out and probably a measured move. Something like this low to this high, add that range to this low, and you would get some kind of a projection. Okay, but right now I'm thinking neutral to bearish on the euro dollar. Cable, we've had a nice uptrending market here, and this one had an ability to get above and outside of this range in here, and we traded up into almost this swing high being taken out. But this one's actually a very difficult market to be in right now. It's not clear, it's not obvious as to what it would want to do. So even though we've had a nice move earlier this year, we've gone into a condition where it's highly suspect in terms of what would be the most likely or probable direction it's going to move next. Now, this looks like a classic chart pattern where folks would probably see that as maybe a bull flag and maybe continuation on the upside. But thinking about what I showed you in the dollar index, that kind of like negates this. Doesn't mean it can't spike up there and do whatever it wants to do and run against the scenario with the dollar index. For now, I just think that we may end up seeing this thing go sideways still, or try to make an attempt to go back below these equal lows here, because we've already cleared out the equal highs, spent some time up here, no follow through yet. But if we trade down and break the middle of this range defined by this high to this low, if we go back below that, okay, the easiest way to do it, if we get below this swing low, I think that would be fair enough. If we break that low, we would save price, try to make an attempt to get down below here to get these double bottoms. Okay, so we would expect a double bottom sweep on liquidity here, because we've already seen a double top sweep here, and we're in uncertain conditions for cable. Why? Because the dollar looks like it wants to go higher, and even though the cable can go higher in that environment because of some fundamental factor that I don't know about, and it could happen, and that's the risks we have in trading. That's why we have to have stop losses and such. But I don't see that that's likely to occur given the conditions in the marketplace here. So this pair I wouldn't touch, but if I had a gun to my head, I would be reaching for these equal lows because of the dollar bullishness as outlined at the beginning of the video. Aussie dollar, this market has gone back into the middle of the range. It doesn't have any real clear direction. We've had a move up, retracement, move up, and now we retraced. We're essentially in the middle of the range. Okay, so in terms of trading, this would probably be a good day trading pair, but a short-term trading or a swing trading, I wouldn't touch this one here. Why? Because it doesn't have a defined movement, and it's made an attempt to get quickly back into equilibrium or the middle of the range. And the range is defined, number one, by this low to this high, and we're smack dab right in the middle of it right now. We tried to go lower with this run here. We've outlined this in a previous video with SMT, smart money technique, and we've rallied up, taken out clean highs. Now it's uncertain as to where it wants to go. So the move is done for Aussie dollar, and we would have to wait for a new setup. So the uncertainty and consolidation nature of this pair would keep me on the sidelines. I wouldn't worry about trading this one. New Zealand dollar is very similar. we would be looking for similar conditions like with the Aussie dollar, but for this pair it looks even worse because we've had an attempt to go lower, 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 lower. Every low has been taken out, and we don't have any kind of clear defined market structure in here to work with. So at best, we probably see it return back to this low here. And what happens after that, it's anybody's guess. So there's no real clear market structure here to frame an analysis on, whereas what we saw with the dollar index and on the euro, there's potential there. So there's clarity in euro dollar wanting to potentially go lower and dollar going higher. Every other pair we've looked at so far is uncertain. Dollar CAD, we've had an attempt to trade lower below this low, aggressive, and then it came back roaring higher, eventually taking out this swing high. Had a retracement, nice optimal trade entry long in here, and we also have a consolidation. So it looks like we could be another leg higher on dollar CAD, if not for anything else, a run on these double tops. So a double top sweep, we would look for that to occur. We've already had double bottom swept here and then rejection. So we would be anticipating a movement higher to clear out the liquidity above these equal highs and maybe make an attempt to go a little bit higher up from the range that's created from this high to this low. Okay, so what I'm looking for is evidence of a clear direction where it wants to go. And when we have areas where, like, we just recently had these equal lows taken out right here and we rejected. We just recently had these equal lows taken out with this run here and it rejected. And it's also left these equal highs in place. So where's the most likely direction going to be? Up. And it's also in favor with what I've outlined in the dollar index at the beginning of the video. So we could probably see a run higher. So there's two conditions that we would be looking for. Euro dollar lower, dollar CAD higher, and dollar index higher. Now, again, this is the condition that I would see right now, but the probabilities are not as high because we're so close to the holidays and it's the end of the year, end of the month. But I'm giving you how I would personally go through the charts and study and look for opportunities or price movement to study how it unfolds in the daily chart. Okay, and then we have the dollar Swissy, kind of like what we've seen with the Aussie dollar, and it doesn't have a real directional bias yet. We do have price coming down below these equal lows. We ran through that and rejected, so we may have an attempt to get it back above here, but if you go a little bit to the left further, we have relative equal highs here. So if we have that dollar bullishness, we could see another leg higher to reach above these equal highs. So I don't like that one so much, but if we want to talk about probable levels to reach for, dollar Swissy, we could possibly see it trade up to that level right in here. And finally, the dollar yen. Okay, and this pattern is a really obvious trading range. Okay, this pair's had a real hard time finding its way out of this range. And I'm just going to add on the levels to save time. And what we're looking at here, I have the double bottoms and old highs noted, and also have the yearly high defined with this range here, looking back 12 months. And we have it defined at the end of this month here would be 12 full months. And also have the ranges with the quarterly. Okay, so here's March, and it takes us to June, September, and we're in December now. And then obviously you can go through and add the individual vertical lines to delineate what the individual monthly highs and lows are. But I didn't want to add all that because it would make the chart really busy. And the question is, how many levels would you have? Well, you're only going to worry about the ones that's right now. Like right now where we're trading at here, the range is defined by, well, we just recently came off this low and we just recently left this high. So we're inside that range here. Okay, we're a little bit less than halfway below that. So if we're expecting bullishness on the dollar, we would reasonably expect the dollar yen to make an attempt to get higher. The problem with this pair is it's really stuck in a range. So you don't want to trade it in the middle of the range. You want to trade it when it gets down to an old low You want to anticipate it running an old low like it did these equal lows here. Run that and then rally. Okay, we have equal lows here. We'd like to see it trade down maybe. Take those out and then rally up, or just leave where it's at and start running higher. We had equal highs here. We punched through it here and then traded lower. We had equal lows here. 1, 2, 3, 4, ran through it and also reached below this low here. So what we're looking for is old lows to be ran out, which it does here, and then rejection. What makes it the rejection? It trades back above the old low. Once that happens, you would look for an old high or equal highs to reach for. Here's an old high. It goes trades to that. We have an old high here. Doesn't get to that. It fails here. Trades back down. It goes back below this old high. What's it going to reach for? Possibly this old low here. It trades back up to this level here as a key level. This is the reason why it makes these levels key, by having defined ranges that are generic. They're not dynamic. They're not ambiguous. They are specific. Okay, previous week's highs and lows, monthly highs and lows, quarterly highs and lows, yearly highs and lows. And by focusing only on those and trading when it gets to those levels and nothing else, okay, we're not trading in here, because on a daily time frame you're stuck. You have to wait for longer term setups. So you're going to have to wait for these levels to trade back to this high, trade through it, maybe reject it, okay, and wait for that candle to close. You'll come home from work and see that it's done that. Okay, so what do? In Asia, you can go short, or you can look at the open at Asia and maybe trade above the opening at Asia and then sell short there, put a stop above that high. And it may be a lot of pips because of the daily range, but again, this is for people that cannot day trade. What are you going to be looking for? Well, we have this low down here. We can hold for that, and it takes a long time. Many weeks go by before it ends up blowing out that low here. So you could have made profit between this price point here and here. Same scenario. When we see this low here, price trades down below it. We wait for it to do what? Come back above it. It does it here. So we could be a buyer on this day here and look for what? Price to trade to where? This old high. Why? Because we have equal highs. So price trades above it, and there's your opportunity right there. This becomes another trade because we have equal highs. It's rallied through that. What are you going to be reaching for? Market below these equal lows. So you could be a seller on the long position and go short, looking for a run below these equal lows here, and it does that here. Okay, we can take our profits, and because we've taken equal lows, we can anticipate a rally again. Since we had this high, take out these equal highs here, we've never came back to this high yet. So that would be the next level of upside I would expect to be traded to. And if we get momentum through that, you can see these double tops taken out. Okay, and that's pretty much what I teach new traders to start with if they're stuck only on this time frame. It takes a lot of time for the setups to form. They cannot do anything else until it trades to these types of levels. Why? Because these are the highest probability levels. Yes, you can do day trading entries, but again, this whole teaching was focused primarily on individuals that cannot be on short-term time frames. They don't have a lot of time, and they have to be looking for something only on a daily chart. This is how you would do it. So there's a lot of things that we could add to this, but I don't want to do too much of that because, again, if you're on this time frame, you're probably very new in your development, and I don't want to give you a lot of things to worry with. Just start looking for double tops and old highs and hold lows and double bottoms, and draw circles on that. Make a notation on your chart. This high here and this high here. Yes, we went above a little bit and rejected, but these are relatively equal highs. So price could come back through that again, and it does. But notice it leaves this high intact. So this is an untapped area of liquidity. And you're probably saying, well, who has a stop up there? Large funds. That's what the market reaches for. It's not your retail stop. Now, your retail stop is going to be placed where the books tell you, and it's going to be the wrong place. But the markets go to large liquidity pools on the basis of other institutional traders or large funds. The market's all designed to go after that. Okay, your retail stop, they can't see it, they don't know where it's at. It's not important to them because you're such a small little blip on the radar in terms of liquidity, they can't pair anything up with you. So large funds, they're trading billions of dollars many times, and that will have a large area of interest for buying and selling, and the market will gravitate to those levels. But they're going to be relative to these highs, these lows, and these double tops and double bottoms. And you can see how the market goes right to them and then starts to look for the other side of the marketplace. So from a higher time standpoint, basically all you're going to be looking for are obvious double tops and double bottoms and single highs and single lows. And where the market most recently came from, just find the opposite direction where the liquidity would be, below the lows, right here. Now this, if it wasn't double bottom or equal lows like this, say this was not a low, this would be sufficient enough because that's where sell stops would be. After running buy stops above here, the market's going to go lower, seeking what? Liquidity. Once it takes that liquidity out below that low, it's going to do what? It's either going to keep going lower for a lower level liquidity, which it shouldn't, because we've already had many attempts to go here, 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 and then rallied away. So if we go below here, we want to see it trade higher. What's it going to reach for? We have this short-term high it reached above, and then we have this high right in here. Okay, so there's liquidity above that one, and we certainly have liquidity above there. And ultimately, if we get momentum above that, we could see these stops rallied out. And that would be in agreement with bullish dollar as well, because the first currency in this pair is the dollar against the yen. So dollar strength in the index would promote strength in this pair. Hopefully you enjoyed this presentation, and you can find more at theinnercircletrader.com.